Hello, this is Ben from ITPM. Hope you have all been able to profit from this recent market volatility. It has been a ride. So before I get started, a quick look at the ideas I mentioned back in January. Okay, so one was long Transocean rig. Stock was at $4 at the time. Okay, and is now at 3. So that one has not really worked out so far, but that's okay. It is structured out of May, and it might still prove itself. The other one is a short in Constellation Brands. STZ is a ticker. And at the time of the recording, the stock was at 220, pretty much. Okay, and it was set up as a ratio put spread. And it worked out real nicely. The stock got as low as 160. And it's now hovering at 180, which was the price target at the time. So that was a beauty. Now, we structure these trades so that the winning trades more than make up for the losers. Okay, so the reward risk ratio is usually around 3-1 or even higher in some cases. So it's pretty nice when it works out like this. All right, so now what is going on, guys? All right, so as always, we start with the tops down kind of macro developments and see what's happening on that front. And with the recent market pullback, fear has kind of crept back into the system. You know, we saw a spike in the VIX. It's going to calm down recently. And then the S&P fell 10% from the highs into correction territory. But look, that said, it's still up 10% or so over the last 12 months. So while it might seem scary at times, especially if you are long Tesla, the overall market is actually hanging in there on a larger scale, considering everything that's going on. But most of the macro data out in February started showing clear signs of a slowdown. Not necessarily recessionary, but definitely a deceleration. We saw that beginning of the month where we had the several macro data points that started to come in weaker, and that carried into March as well. Okay, with the ISM manufacturing data backing off, coming in weaker than consensus, and then the major overall concern here being the fallout from the tariff impact. Okay, now the actual inflation data that was out last week was weak, you know, but it hadn't taken the tariff into account yet. So, you know, it's yet to be seen how this is all going to shake out. In fact, the Michigan consumer sentiment that just came out confirmed that the concern now for inflation expectations for the next 5 years is actually showing the largest month-over-month increase since 1993. So there's definitely a big concern of the inflationary or potential inflationary impacts of tariffs. Bond yields haven't really moved much so far in March, so this is like a wait and see type of situation, right? Now, in a couple of days after this episode airs, actually, we're going to have the FOMC Fed decision and the forward projections, which will likely to set the tone for the near-term market action impact. So something to keep an eye on. So with this market volatility, it is really the perfect environment to trade option spreads. Okay, so you can have long and short exposure, even in a retirement account, in an IRA, in the US at least, with limited risk and unlimited upside potential, regardless of which way the market goes. So instead of just kind of sitting there long only stocks and hope things are going to get sorted, thinking that that's a safer bet, you're better off protecting yourself. I mean, has the market bottom? Are we going to rebound from here? Who knows? There's a good chance of that, but we'll see what happens. There's a lot of uncertainties still. This is why we want to have a fairly balanced portfolio of long and short ideas and always contain risk. Okay, so with that, I have an idea in mind that we can have a look at. We have seen heavy selling in many tech stocks on the back of a deceleration for future growth prospects. So fair enough. However, it's not like AI is going away anytime soon. Okay, it's still likely to experience exponential longer-term growth. And yeah, there could still be opportunities in kind of the larger hyperscalers. However, for now, the steam has kind of been sucked out of these names. And I'm more interested in the smaller companies with just massive upside potential in the early stages of their growth phase. So have a look at the SoundHound, ticker SOUN. What do? They provide generative AI voice to action capabilities. And how is that different than the typical kind of voice recognition process? Well, normally, voice to AI tech use a two-step process. Okay, where you talk and the speech gets converted into text. Then you have automatic speech recognition software that takes the text and converts it into meaning. So there's a kind of a two-step process, and that works well enough. But it's just not the way our brain works. You don't think about uh, doing something and then you turn it into a text and then you actually do it, right? So this process is a lot more efficient, it's faster, more accurate, and it's just a way of the future. And that's what these guys do. Now the stock is trading around $10 mark after coming back from a high of 25 in December. And clearly that in itself doesn't make it a buy idea for sure. And they have experienced some growing pains. They acquired another speech recognition company last year called Amelia Systems, which inflated their revenue growth and also resulted in some issues with their 10K being delayed due to the complexity of the deal. So there's a pretty good reason why the stock has done what it's done. And they have several partners, including collaboration with NVIDIA for in-vehicle voice technology, right? And just when you have the overall weakness in AI-related stocks, it doesn't help. It hasn't helped this company, right? So it's going to put further downside pressure on SOUN. So yes, there's been headwinds for sure, but look, the longer term growth prospects in this space is extremely favorable. And this company still have very strong quants, especially on the balance sheet. We'll have a look at that in a second. But it does require a longer term view. So they are pre-earnings, okay? But the revenue growth was 85% last year. And they are close to 100% revenue growth going forward, well, for this fiscal year. And yes, part of that was the result of the deal last year, but still, their balance sheet is very strong. They have 200 million in liquid cash, with another 50 million in receivables versus current liabilities of 68 million. So the quick ratio here is 3.7, meaning they can meet their short-term obligations more than 3 times over. And there's another thing going on. It's a heavy shorted stock. So they have a short interest of 33%. So that makes it very susceptible to a potential short squeeze if the stock and the whole space really starts moving higher. Earnings are scheduled for early May. And I think the stock could potentially get up to the December highs to 25 later this year. That said, that might take a while, and I will scale back my optimism to, let's say it gets to 20. Okay, so it doubles between here and July, which is not unrealistic considering the volatility in this name and in this space overall. And even if that doesn't happen, it can still be a very lucrative setup. So let's have a look at this chain, right? A more speculative play like this, I want to look at this further out in the chain than typical. Okay, plus that the expiries are either April, which is way too close, or July. So here, looking at going long July or 30 or the July 12 strike calls at $2. The $6,000 spend. And then to hedge out some of the time value and the high implied vol, also short 20 of the April 14 strike calls at 50 cents. That gives me a credit of $1,000 that I keep as long as the stock stays below 14 until April. Okay, then they expire at 0, and I keep 100% of the credit. So the total spend for this setup is $5,000. It has unlimited upside potential right out of the gate, and especially over earnings in May. And if it rallies, let's say something happens, right, and it just starts banging higher, it gets squeezed, rallies above 14, before the short leg expires, it will still be a solid trade because I'll be net long 10 calls. Now, with the stock, let's say it gets to 20, right, in July. then the math goes like this. You have the $20 price minus the $12 strike minus the $2 cost times the 30 size, okay, times the 100 multiplier. It's $18,000 profit, and then you add the $1,000 credit from the short leg, and you're looking at a $19,000 profit for a $5,000 spend. And if the stock doesn't go anywhere, okay, it stays below 12, let's say until July, and we do nothing about it, we just keep our head in the sand, it will be a total loss of 5,000, but that is the max risk. Now, there's a lot of things, actions that we can take between now and then, okay, to maximize our profit potential, but also lowering the risk profile. So it's not like we're not just going to sit there and let that happen. It's a pretty classic setup for this type of play. And I'm going to keep this short and sweet. That's what I have for this episode. One final word in this market. Don't get suckered into panic selling or also start chasing rallies in this market. Okay, have a plan and execute a process. That's it for now. Over and out.